Number 1. Digital payments. Digital payments let people and businesses send and receive money electronically through cards, mobile apps, online gateways, and APIs instead of cash or paper checks. Payments is the largest fintech vertical, generating around $126 billion of scaled fintech revenue in 2024, with digital wallets alone contributing roughly $67 billion and merchant acquiring plus vertical SaaS about $50 billion. Revenue mainly comes from transaction fees. Processors like Stripe or Adyen charge merchants a small percentage plus a fixed fee on each payment, while wallets and gateways may add cross-border markups, currency conversion spreads, or premium service fees. Because these fees apply to every swipe, tap, or click, the model scales with volume. Once the infrastructure is built, more transactions add revenue faster than they add cost, but it's still sensitive to macro conditions and consumer spending cycles. Number 2. Peer-to-peer payments. Peer-to-peer P2P payment apps let users transfer money directly using a phone number, email, or username, often with social features for splitting bills or adding notes. They grow quickly through network effects. The more friends and merchants on the platform, the more valuable it becomes, which explains the rapid adoption of services like Venmo, Cash App, and region-specific bank-linked apps. Most keep basic transfers free to drive growth, and then monetize around the edges via instant withdrawal fees, business and merchant accounts, cross-border remittances, and interchange on branded debit cards. Some also experiment with financial services marketplaces offering credit, savings, or crypto through partners and earn referral or revenue share commissions on those products. Number 3. Neobanks. Neobanks are digital-only banks that operate via apps and web platforms, often partnering with licensed banks for deposits and compliance while focusing on UX, pricing transparency, and speed. They earn money through a mix of revenue streams: interchange fees every time users spend with neobank debit or credit cards, premium subscription tiers, lending margins on overdrafts and loans, FX and crypto trading spreads, SME banking fees, and partner commissions. In many neobanks, 30 to 50% of revenue comes from interchange, 20 to 40% from credit, 10 to 20% from subscriptions, with the rest from FX and partner services, reflecting a shift from pure card economics to deeper financial ecosystems. Their digital-only model cuts branch overhead, allowing rapid user growth, but profitability still depends on driving regular card spend, managing credit risk, and converting free users into higher-margin products. Number 4. Buy Now, Pay Later, BNPL. BNPL services let customers split purchases into installments, commonly pay in 4 over a few weeks, integrated directly into e-commerce and point-of-sale checkouts. They are a fast-growing fintech vertical. Although BNPL and POS lenders currently account for a smaller share of total fintech revenue, they are scaling rapidly thanks to high merchant adoption and consumer demand for frictionless credit. The primary revenue source is merchant fees that can range from about 2% to as high as 7 to 8% of the purchase value, significantly above standard card processing fees, which merchants accept because BNPL tends to increase conversion rates and basket size. On the consumer side, providers earn from late fees, flat transaction fees, and in some products interest on longer-term installment loans or busted loans that roll into traditional credit. The challenge is balancing growth with credit losses and regulatory scrutiny, as rising defaults and high operating costs have pressured the profitability of some BNPL players. Number 5. Online lending. Online and fintech lenders offer personal loans, SME loans, point-of-sale financing, and microloans through fully digital channels, using automated underwriting and alternative data. They make money mainly through interest margins, the difference between what they earn on loans and what it costs them to fund those loans, plus origination fees, servicing fees, and sometimes referral or platform fees when they match borrowers with third-party capital. Algorithmic credit scoring and data-driven risk models allow these platforms to approve or deny applications quickly, target specific niches, and price risk more granularly than traditional manual underwriting. The flip side is exposure to credit cycles. In downturns, rising defaults can quickly erode margins, so successful lenders invest heavily in risk analytics, collections, and diversified funding sources. Number 6. Investment apps. Investment apps democratize access to markets by letting users trade stocks, ETFs, and other assets via intuitive mobile interfaces with low or zero commissions. Many brokerage-style fintechs have shifted away from visible per-trade fees and toward indirect monetization, including payment for order flow, PFOF, securities lending, interest on uninvested cash, premium subscriptions, and margin lending. PFOF means the broker routes user orders to market makers who pay for that flow, monetizing spread capture while users experience free trades, a model that has drawn both regulatory and public attention. On top of that, tiered subscription plans can unlock advanced analytics, higher instant deposit limits, or tax and options tools, converting their most engaged users into recurring revenue. Number 7. Robo-advisors. Robo-advisors use algorithms to construct and rebalance diversified portfolios, often using low-cost ETFs aligned to a client's risk profile and goals. Their core revenue is a percentage of assets under management, AUM, for example, 0.25% to 0.50% per year, sometimes complemented by subscription fees, cash sweep margins, or additional advisory products. Because portfolios are automated, robo-advisors can serve many small accounts profitably, targeting investors who might not meet minimums for traditional human advisors. Their competitive edge is low fees and a simple UX, but they must reach substantial scale in AUM to cover acquisition costs and maintain margins in a crowded market. Number 8. Cryptocurrency exchanges. Cryptocurrency exchanges allow users to buy, sell, and trade digital assets like Bitcoin, stablecoins, and altcoins, sometimes offering derivatives, staking, and lending as well. They typically earn revenue from trading fees charged as a percentage of each transaction, tiered by volume and user type, along with listing fees for new tokens, withdrawal fees, spread margins on instant buys, and interest/spread on lending and staking products. Because crypto markets are highly volatile, trading volumes can spike dramatically, boosting fee revenue in bull markets but making income cyclical and sensitive to sentiment and regulation. Larger exchanges diversify into institutional services, custody, white label infrastructure, and derivatives to build more stable, multi-segment business models. Number 9. Blockchain infrastructure. Blockchain infrastructure providers sell the picks and shovels of the crypto and Web3 ecosystem: node hosting, APIs, custodial services, key management, indexing, analytics, and transaction validation. They monetize through SaaS-style subscriptions, per-call API pricing, enterprise contracts, custody and staking fees, and sometimes protocol-level rewards for running validators or nodes. This B2B focus makes revenue less dependent on day trading volumes and more tied to the overall adoption of blockchain in payments, DeFi, gaming, and enterprise use cases. As regulations clarify, institutional demand for compliant custody, reporting, and infrastructure is expected to be a major growth driver for this segment. Number 10. Insurtech. Insurtech companies use data, automation, and digital interfaces to streamline underwriting, policy management, and claims in insurance. They can operate as full-stack insurers, MGAs, managing general agents, or technology providers to incumbents, earning money from risk premiums, commissions, and licensing or usage fees for their platforms. Automation reduces manual processing costs and can improve pricing accuracy by using granular behavioral or IoT data, which widens margins if risk models are accurate. Some insurtechs also embed insurance into other journeys, like travel bookings, e-commerce, or mobility, earning a small cut on each policy sold through partners. Number 11. Embedded finance. Embedded finance integrates banking, payments, lending, or insurance directly into non-financial products such as ride-hailing, marketplaces, SaaS tools, and retail platforms. Instead of sending users to a bank, these platforms offer cards, loans, BNPL, or accounts inside their own interface, often powered by banking-as-a-service or payments-as-a-service providers in the background. Revenue comes from revenue sharing on transaction fees, interchange, lending interest, and insurance margins, plus markups on financial products sold within the ecosystem. This model is attractive because it monetizes existing user flows, rides, orders, invoices, without needing to attract standalone banking customers, turning software companies into distribution channels for financial services. Number 12. Fintech consulting and SaaS. Finally, some fintechs don't face consumers at all. They sell software and expertise to banks, insurers, and other fintechs. These B2B players offer compliance tools, KYC/AML platforms, risk and credit scoring engines, core banking systems, API gateways, analytics dashboards, and more. Their revenue is primarily recurring: subscription licenses, monthly or annual, usage-based fees, implementation and integration projects, and sometimes revenue share on transactions run through their software. This model is attractive to investors because it tends to have predictable cash flows and high gross margins, but it depends heavily on long sales cycles and strong customer retention.